Look, I get it. There's a big misnomer out there that the markets can't be forecasted, that you can't possibly, with any precision, predict when and where a move might happen that you can take advantage of. I get it. Let me show you that that's not only not true, but you can actually do it on teeny tiny time frames like this, a 15-second chart. That's right, every one of these candlesticks is just 15 seconds of action on the E-mini S&P 500 futures. So here's a situation where there was data that came out at 8:30 Eastern that drove a lot of market action pre-market, but the forecast I'm about to walk you through happened after the market opened. I'm going to show you what the forecast suggested would be the expected price and time to buy. I'm going to show you what the forecast actually did, how you could have taken advantage of it, and how you could have used another forecast to exit. Now, I'm going to just show you the entry and exit points and mark the general forecast if you want to learn about how to forecast for yourself my way. That's in my loss forecasting trading system. All right, so here we go. There was retail sales data at 8:30 Eastern that really fueled the ES futures higher and suggested that the consumer is strong, yada, yada. So the market liked it, okay? And you can see it took us well into the 9 a.m. hour, and the market then started digesting that move after 9 a.m. So now let's just get a little closer to the action on these bars. Because the first thing I'll tell you is this. Forecasting comes down to taking price action and the cycles within it to find areas of supply and demand. So the first area you would need for this forecast was back here, okay? So once this high formed, I was watching for an opportunity, and here's how it unfolded. So again, to make it easier to follow through, I'm gonna thicken up the bars, and let's get back to that action. So we were coming in 9:26, 9:30, okay? So the market open was back here at 9:30. This little red candle here was the first candle of the regular session. The market pushed higher, and then it started to pause. Those of you who use my RSI Power Zones momentum indicator may even see the disconnect between price and momentum, right? The bull-bear RSI face-off. So this was an area where a pullback was expected, but again, because the bigger picture of this market was to the upside, I wasn't going to look to find a short move. I was looking at where could an entry long happen. So the market chopped around for a bit. It wasn't really super clear. Yes, it came back to this full support, but based on a forecast that started to unfold, I didn't want to take action here. It was too high risk for me. Now, the forecast didn't unfold until this yellow line here. See? So because of this being a kind of last push up, then we end up getting another bigger bull-bear RSI face-off. I just stayed out of the way. This is still just the first 5 minutes of the open. But then I started to pay attention and look at where could I buy down below. Because now, as of the formation of this bar highlighted in yellow, I had insight that we might actually be correcting lower. And I'd rather buy on a deeper pullback than a shallow one like this when there's so much volatility because of news. So the yellow line here marks the earliest that you could have been prepared to buy at a forecasted level down below. All right, so that's the first step. Again, the full forecast would show you exactly where this lands, but I'm going to tell you the result. So the result is the beginning of this green line. At this time, so this was 9:40 and 30 seconds, I was getting prepared for the possibility that the market might hold at 5528, and that would be an area to go long. You would use a stop based on your money management, like a fixed number of points, whatever that is in your trading plan, or your stop would have had to be below this prior low from 9:22 a.m., okay? And check it out. The market fell right into it. So you could have had that order sitting out there waiting and ready. And if you did, you would have been filled here even though the expectation was to be filled much later in time. So what happened is the market came to the forecasted buy point faster than expected. And then it started to slow down. So after this red candle, it immediately had a green one. Tested it again, put in a hammer candle. And again, if we widen up the bars so you can really see the details, you can see that the whole set of basing formed here. So this arrow, these black lines that I've assembled, okay, The first one at the top points to the earliest you would have been prepared for this bigger forecast to the downside. And this bottom set here shows the exact price level you could have entered at long. Now you could have entered right on the return or waited for it to show that it was holding. Either way, this is what started to unfold. So let's narrow the bars back and you can see the market started trading higher. And guess what? As early as 9:48, when it started to go higher off of another higher low, that's when you could have been prepared for a forecast out for the exit for this position, okay? So if you're long from where you planned to enter based on the forecast, we have a plan for exit and I have a time for that forecast. So a new forecast was drawn, planning to sell at 5543.25. So up here, likely by 10 a.m. It's not just the price target, it's the time as well. And check this out. While the entry was much earlier than the cycle projected, the exit, the market was moving steadily towards it, and here was the exit. So the expected time for the market to get up to 554325 was here at 10 a.m. And when you look at this on a 15-second chart, it looks like a ton of bars away, but look, it was only 2 minutes away, 2.5 minutes away. So at 10:02 in 15 seconds, you could have had a resting order, meaning it's sitting out there to exit your long position, all just based on forecasting, completely, 100%. And that would have gotten you out of this long position, having ridden this healthy move here, of course, with any other trade management you bring in, and then you would have stayed out of the way of this garbage fire that happened, where everything just got dumped. And then the whole thing can rinse and repeat again. You can do forecasting in a cyclical way, on and off, so long as the market's presenting the opportunities to draw the forecast. And this is more the case when the market is trending like it is right now. It doesn't matter if it's trending up or down. We just need a clear direction. So how did this all shake out? Well, the market's still trading and moving, but I just want to show you the math here. Entering long at 5528.25 on the ES, say you just did one contract, and exiting it at 5543.25, that's a 15-point move. And at $50 a point in the ES, that's $750 in just one contract. And you know what? Guys, time is money, and money is time, right? So think about this. This isn't, hey, you have to sit there all day and trade for 4 hours to make $750. This was done by 10:03 a.m. So you were prepared for the market. I recommend getting prepared to day trade at least 15-20 minutes before, ideally earlier than that, depending on your approach. Because the more short of a time frame you trade, the more you have to go through higher time frames to be ready for this kind of action, okay? And guess what? This forecast isn't exclusive to the 15-second chart. The 15-second chart is just a more detailed version of a 3-minute chart or a 5-minute chart. And you could have seen this forecast there if you knew what you're looking for. So this is just one example of something that happens over and over and over and over. But I wanted to show you that, yes, you can forecast the market. Yes, you can be prepared even when the forecast doesn't hit on the nose. So this 5528.25 was hit much earlier. I thought it was going to be hit out here, but it was hit faster. And then, like I said, the 5543.25 exit was hit practically on the nose. And above all, this is something that you can use in volatile market environments. And if you're watching this video now, it's August 15, 2024. It's my 45.5 birthday, so it's always a special day for me. And here we are, 5 weeks out from jobs data, who knows how many weeks out from the election, with whatever changes might be happening there for US president. There's so much potential for the market to be volatile on top of regular things like, hey, tomorrow's the third Friday of the month, and that's options expiration, and that tends to fuel volatility. So if you don't have the confidence in applying any of your technical skills, whether you learn them from me or anyone else, to short-term time frames to help you refine your trades and get better entries and exits, then you might be missing out on some historic opportunities. So I advise you to follow me along. Don't just check out my videos if you're floating around here on YouTube. Make sure you're on my email list. There's a link below to make sure you've joined my email list. And I would love to know if this added value to your trading, right? Seeing how you can forecast to bring this to life. I'll add this for my loss forecasting students. I'm going to post a full analysis of this same exact chart in our forum. So go check that out there. I'll actually put the link for it down below. So if you have the loss forecasting trading system where I teach how to forecast and even make money off the misses, you'll have a link in this video where you can look at the full-blown chart of this with the forecast and head on from there. All right, again, my name is Hima Reddy. I use price, market timing, momentum to boost my trading and that of my tribes. Can't wait to see what else unfolds in these crazy market conditions. If you found value in this video, please subscribe to the channel, like the video, comment down below, and biggest of all, if you haven't already, come join my email family where we send out updates like this and many others as well. All right, catch you next time.